Hi, Matt McAleer, President, Cumberland Advisors, with John Mousseau, our CEO, Director of Fixed Income. Well, nice tailwind again this week. Had some data out in fixed income.
Yeah, it was a week where I would say the markets kind of settled on their haunches a little bit after the big run we've had with yields coming down over the last month. So if you took a look, you'd look at the 10-year bond. It was up 4 ticks from where it was. Why? You had a stronger than expected jobs number today by a little bit. Still lower than it was at the beginning of the month. Got as low as a 411 earlier this week, and that's a pretty low print considering you had 5% towards the end of October. Interestingly enough, Muni yields were down on the week, and a lot of that is the fact that supply has basically retired for the year, and so money is now sloshing around trying to look for a home, and there's not a lot of deals being priced, so they're taking yields down there. So
supply and demand.
Supply and demand, and we have hit the holiday doldrums, my friend.
Yeah. Well, in terms of the broader equity markets, similar.
Right.
A little backing and filling in the large cap. Still a nice solid bid in small and mid cap. I'm going to pop a chart up here just to give you an idea, folks, over the last month, the kind of performance dispersion we've seen between IWM, the Russell 2000, and the NASDAQ 100 and S&P 500. When you're talking about 400 basis points, that's real dispersion. Keep in mind, we go back 4, 5, 6 weeks, get back to late October.
Right.
We hit, not that it's magical, but we hit that 20% dispersion between the S&P and the Russell 2000 in performance.
Right.
Okay, John? So when we're talking about that kind of spread, first of all, historically, it happens rarely.
Right.
Very rare occurrence. It has not historically gone much beyond that without a reaction.
Right, and you've seen some of these smaller cap and mid cap stocks get off the mat and start fighting back.
Yeah. So you investing is always multiple inputs, right? And we talk about this from time to time. Having a basket of longer term, stronger trending, stronger relative strength names that you may want to hold and fight through drawdowns. You may want to hold 3, 5, 10, 15 years. And then your shorter term bucket or your shorter term capital. That type of reversion to the mean trade can be profitable.
Sure.
So we saw some nice moves in US ETF in our IJR position, which is small cap 600, as well as we have a small micro cap position David put on there, and that's had a nice rip. In terms of core, that's having a nice move in the mid cap area and a very nice move in the value area. So again, that's been the areas that have been left out of the rally. Seeing a little bit of a bid over in tactical, a couple of tactical trend, a couple of things that are working nicely are industrials. Think back to October when we said that pullback in industrials really looked attractive. And we put on additional industrial exposure. Really what's working nice there is the small and mid-cap industrials.
Which are reacting to the fact that interest rates are decently lower than they were, at the end of October.
So we'll see where this little continued rip goes. Remember, we're not in, although I hear it already being discussed in the media, we're not in the Santa Claus rally stage. Traditionally, according to the Stock Traders Almanac, the Santa Claus rally is the 5 last trading days of December and the 2 first trading days in January.
Oh, there you go.
So that's where it is in
Still
terms
to come.
of the definition. We'll see how the market sets up for that push in terms of what we're seeing now. Good steady bid.
Yeah, it's been nice to have some decent markets at the end of the year.
Sure is. Well, enjoy the weekend. Get ready for the holidays, and we'll see you next Friday.